We've got a great show lined up for you. We're going to be talking about systematic risk. What does that really mean? What does beta mean within your portfolio? We're also going to be diving into a case study of looking at a retired couple and what that looks like going all the way through the process of retirement planning. And lastly, 2 ways to grow a portfolio. What's going to be the best route, whether it's yield or appreciation? Again, you want to stay tuned to learn a lot more coming up here on Retiring Well.
Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
Have you ever heard the old saying, all ships rise and fall with the tide? Well, in our industry, that's systematic risk, or sometimes referred to as beta. So let's take, for example, a mutual fund or maybe an exchange-traded fund where you're going to be tracking the S&P 500. So essentially what that investment's going to do is it's going to move up and down just like the S&P 500. So when you turn on the news and you see, oh, the S&P 500 did this or that for the day, then you can expect that your mutual fund or exchange traded fund essentially saw similar returns. So you might have maybe more like a large cap mutual fund. Again, if a lot of those holdings are going to be those same holdings that are going to be in the S&P 500, then you could totally expect to see things perform similar. Which, again, that could be a good thing if the markets are trending up, but also could be a bad thing if essentially you're seeing the markets take a major dive. So when we're talking about this and we look at the term beta, which is spelled B-E-T-A, just so you know, so beta of 1 is essentially an investment that mimics the market, like the S&P 500 or a certain benchmark. When it's less than 1, that it essentially says, okay, it's going to be less volatile than the market, or say the S&P 500, if again, that's your benchmark. When you look at something that's going to have a beta of greater than 1, then you could anticipate maybe greater volatility within that index. So that might be perhaps like a small cap type of stock index. A negative beta of -1 means it's inversely correlated to the benchmark. So you might be seeing things work in opposite directions in that case. So you might be looking at maybe put options or inverse exchange traded funds. So knowing this score can help you better understand how your portfolio operates, because it's helpful to know that if you're in a situation where you're saying, hey, I don't know if I really want to take a whole lot of risk, but if you're finding that you have a beta of 1 and your stock investments are going to perform essentially the same as the S&P 500, then you could anticipate that there's going to be major rises and falls within that portfolio. So here at Centennial Wealth Advisory, we can dive behind those investments and analyze that to better determine what your beta score is and what sort of systematic risk you could expect leading up to retirement and in retirement. So if you're interested in a no-cost, no-obligation visit, we'd love to sit down and talk through that further with you.
Risk, what a topic there that they just talked about. It's a very important topic and something that that's like the first thing we want to get behind, is understanding what your risk tolerance really is. And you know, so often people come into the office and I ask them, well, what's your risk rating? And they'll be like, well, I have a moderate approach. And then I ask, well, what does that mean? And most of the time, they have no idea what that means, right? What's really unique with us is that we have a software program where we can get behind what all your investment tools are doing for you and pinpoint that risk. So you understand, hey, in a really bad year, I have a potential to lose X amount of money. Or in a really good year, I could make some money. But it's just so important to understand how much risk you're really taking and get that clear picture so you know, worst case scenario, what you could expect.
Absolutely. I love how Nick just said we get to pinpoint your risk, and that is something that we love to lead with, because if you don't know your risk and you don't know why you're taking the risk, then what's the purpose of the risk? And not knowing that is a risk. You know, a lot of times when I'm trying to explain to clients what the goal of risk in the portfolio, what that looks like, I use a picture from my personal life where it's a picture of me water skiing with my kids. And this picture that I'll paint for you could come across as way too much risk. But because if you look at it from an uneducated standpoint, meaning that you don't know the purpose behind and what I've done to prepare for those risks, yes, it would look completely out of sync with the risk that I should take. But so here's the picture. So I have my daughter Ellie. She's on my shoulders. I'm carrying my son Micah, and my twin sons are skiing next to me. And that one picture, I can pinpoint exactly where the risk is of the picture. You know, when my daughter Ellie's on my shoulders and we were to fall, that would not be a good thing. I could pinpoint different parts of the picture that says, there's our risk, and now let's talk about, now that we've identified what it is, what are we doing about it? You know, my dad was driving the boat. He's pulled me skiing for 35 years. You know, there's all the skis that I'm using are these big, wide, parabolic skis. I've fallen so many times on the water. I know what to do and what not to do. So there's that experience in that risk mitigation. And so at the end of the day, it's just a quick little visual for you to maybe think about, okay, what is my risk and why am I taking it? Can I pinpoint it? Because if you get that worked out, I think it really helps give you some peace. You can see markets react, you can see your portfolio adjust, but you know why and where your risk is and what you're doing about it. So if you're at all, you know, curious about your own risk, what that score might look like, your beta score, or how closely it might align with the markets, or more importantly, if you don't have a contingency plan to do something about the risk, then feel free to give us a call. So stay tuned, because coming up next, we're going to be talking about a case study you do not want to miss. See you soon.
During a market downturn, people tend to panic. That's a natural reaction to seeing your retirement savings decline right in front of your eyes. Take a deep breath. We can help. We recommend the following 3 steps. Number 1, schedule a risk exposure review and make adjustments if necessary. Number 2, request a retirement income analysis to serve as the starting point for your retirement strategy, making sure your money lasts as long as you do. And number 3, develop a holistic financial plan. Call or click to request a free, no obligation meeting, either in person or over the phone or video chat. We look forward to meeting you. Plan to retire well.
When it comes to your financial future, what's the value of a truly objective opinion? As someone looking for financial guidance, you have choices. There are thousands of captive financial professionals who work as employees for large national insurance companies and brokerages. There are also many independent financial professionals who aren't bound to any given insurance company, investment strategy, or product. So what's the difference, and why does it really matter to you? Consider this. If you walked into a doctor's office with a sore throat, a bad cough, and a high fever, you'd expect that doctor to assess your symptoms, do a thorough diagnosis, and ultimately hand you a prescription written to cure your particular ailment. In other words, you'd expect the doctor to consider all the medications available and give you his or her absolute best thinking on what's best for you. On the other hand, if that doctor opened the cupboard and only had 3 or 4 prescriptions available, maybe those offered by his or her favorite pharmaceutical rep, most patients would immediately raise an eyebrow, suspicious that they might not be getting what was really in their best interest. The same may be true for your financial well-being. If your financial professional is an employee who's contractually bound to represent a given insurance or investment company, only offering their products while there are literally hundreds of others available, how sure can you be that you're being offered what's truly best for your situation? You don't walk into a tailor or seamstress shop to get clothing off some rack. You go for a custom tailored fit. And with something as important as your financial future at hand, the stakes are even higher. We believe you deserve a truly objective opinion. We think you deserve to consider more of the available options, and we believe your financial future is worth a custom-tailored prescription to help you feel confident for the days ahead. If you'd like a second opinion on your current retirement strategy, simply contact our office today.
I want to take some time here and do a little bit of a case study. I want to walk through an example we recently had come into the office here and maybe help you make some decisions or think about some things so you don't have this happen to you. First, let's set the stage here. It was a married couple. They were 62 years old. They had saved about $800,000 in their IRAs, 401ks, pre-tax money between the two of them. And they also had about $400,000 of money outside of that. Think cash, savings account, non-qualified stuff after tax type money. Now they wanted to live on $48,000 a year in retirement. They also were fortunate enough to have a pension of $12,000 a year, about $1,000 a month, right? So they wanted $48,000, and they knew they had about $1,000 a month coming in to get 12, so they needed to make up about another $36,000. Well, they basically had three options, right? They could started their Social Security, they could started taking money from their IRAs, their pre-tax money, they could start taking money from the non-qualified, the after-tax money, or I guess there could have been a combination of that. Well, their previous advisor suggested to them that they should start drawing $36,000 a year from that after-tax bucket, so basically cash savings account. The benefit to that at that particular time was that they would not be paying any income tax. They had $12,000 of pension, and then they basically had $36,000 of after-tax money. So when you basically do your tax return as a joint couple, really there would be no federal income tax liability. During that time, when they were drawing that down, they were deferring their Social Security, allowing it to grow, and then they were not taking any distributions from their IRA accounts. So once again, those were invested and those were continuing to grow over time as well. So basically, you had a scenario where pulling one account down and the other account was growing during that same time period. They were living just fine, getting the lifestyle they wanted, reaching to $48,000 a year. So when we started looking at the scenario, they were kind of bragging in a way that they were not paying any income tax, and they hadn't done so for some time now. Now, they were approaching the age of 72. Obviously, they had turned on Social Security now because they had deferred it all the way up to age 70, but now they were starting to wonder about required minimum distributions. So you might be wondering, what's the problem? They were meeting their income, they were growing their investments. There was one key thing they were not planning on. Stay tuned, coming up next, we're going to talk about that one big mistake.
In today's day and age, with a longer lifespan, you're more likely to encounter both good and bad market performance. For that reason, when planning for retirement, it's increasingly important to seek guidance from a financial advisor who can help you structure an income strategy that reflects your financial situation, risk tolerance, and investment objectives. You don't want just any advice, but objective financial advice. With so much at stake, it's important that you feel you can trust a financial advisor to consider a wide variety of possible solutions, including both investment and insurance products. Here at Centennial Wealth Advisory, we're not beholden to any certain investment tools or vehicles. We're independent. We can offer a wide variety of investment tools that meet your needs. So please, if you have any questions or you want to schedule an initial consultation, don't hesitate to give us a call at the number on the screen. We're happy to help in any way that we can.
right, we just talked about the good that's happened along with this couple's scenario. They wanted their $48,000, they were getting their $48,000, they were paying no federal income tax. Many of you are probably saying, wow, I'd love that scenario, right? But what the problem was is they failed to consider required minimum distributions on that IRA money. So remember, they retired at 62, started drawing. Between their two sources, they had about $1.2 million, $800,000 in pre-tax IRAs, $400,000 in after-tax. Now, fast forward to the age of 72, they have about $1.4 million in their IRA, and they've drawn down that non-qualified to about $100,000. So now they have about $1.5 million. So they have more than they started with, and they drew income for several years. The problem is now they have required minimum distributions and they've deferred their Social Security. So they have a pretty significant Social Security. So now they're 72 years old. They still have that $12,000 pension, but between the two of them, they now have $60,000 of Social Security as well. And their required minimum distribution is about $52,000. They still want to live on $48,000, or let's say it adjusted inflation it up a little bit, but still. So now look at that. They have $60,000 of Social Security, $12,000 of pension, and about $52,000 of RMDs, required minimum distributions. Now that's not only put them in taxable income, it's moved them all the way up to the 22% tax bracket. What they failed to consider is they were growing a taxable asset when taking money from a non-taxable asset. So there was some big missed planning or missed opportunities. Now, forevermore, they now are grouped into this where they're going to have higher required minimum distributions. So that's at 72. Let's fast forward even 10 years down the road, looking ahead. What if they're still living 10 years from that? And they've got a reasonable growth rate in the required minimum distribution where it's slowly inching up as they're taking those out. Remember, required minimum distributions, you have to take a little bit more as a percentage every year. So if your balance is increasing, that required minimum distribution. So I kind of did some hypothetical numbers and looked ahead and basically learned that roughly in 10 years, their required minimum distribution could be as high as maybe $97,000. Well, hopefully their Social Security went up a little bit during that time. So imagine this. $72,000 of Social Security, $12,000 of pension, and then almost $100,000 of required minimum distributions. Folks, now we have a big tax bomb on our hands. Or even what if one of them passes away? So these are all things you need to be considering of. Folks, if it seems really good today, maybe it is, but don't forget about the long-term nature of this outcome. Retirement is like 20 to 30 years of unemployment, and we have to be always looking ahead, not only from an investment perspective, but also from a planning, income planning, and tax planning. If you're not sure you're doing this correctly or you need some help with this planning, give us a call. We'd love to help you through this.
What a great segment there, a case study that you can actually learn from. There's so much great information in that. And what Art really covered was the holistic approach that we take here at Centennial Wealth. It's pretty unique in that we look at all those aspects of your retirement plan. Case comes to mind just recently that I had where a client had developed a plan that he thought was great. Okay, he had just retired and he planned on doing large Roth conversions early in retirement. What he didn't really think about was the health insurance piece, okay? Because those Roth conversions, they affect his income. And he was on marketplace insurance under the age of 65, getting a subsidy for his health insurance. When he did those Roth conversions, what happened? Well, it made his subsidy limit go through the roof, right? And he wouldn't qualify for a subsidy anymore. So it's just so important to both have a plan, but also get a second opinion from time to time. There's so many different variables that if you're not looking at all of them, you could be missing something that will definitely dramatically affect your retirement plan.
Yeah, and I love how many times you get to talk about and how many times we get to talk about the power of a plan. I heard a study, they talked about how long, when you buy something new, something fancy, a new car, a new doodad, something like that, how long endorphins are released when you think about it. And the study basically says it's anywhere from 3 to 6 months. So you get that new gadget or that new car or something that you have been saving up for and really enjoy. hey, you're going to get positive emotions for 3 to 6 months. They say though, when you have a plan, okay, that actually will release endorphins the entire time that you think about your planning. You know, if it comes to estate planning, what's going to happen to all my assets when I, pass away? Well, when you get that plan in place and then you think about that you've done the work to put it into action, endorphins are released. And so that's a cool way to think about the power of planning, that when you might not have thought about all of the different parts that go into a good holistic plan, that's why we love doing this TV show. We get to teach the different things to think about. But if you want to know, specifically individualized type planning, then give us a call. We'd love to sit down, learn your story, and learn how we might be able to help. So, hey, stay tuned. Coming up next is 2 ways to grow a portfolio. You can have a portfolio, or you can have a plan. You can play it safely, or you can safely plan. You can guess when to take Social Security, or you can make your decision based on detailed analysis. You can hope your savings will last your entire retirement, or you can take action and know. You can let life happen to you, or you can take control. You can go it alone, or you can have an experienced guide ready to walk with you every step of the way. We are Centennial Wealth Advisory, financial planners serving all of northern Michigan, offices in Gaylord, Petoskey, Traverse City, and Cadillac. Simply call the number on your screen for a complimentary initial consultation and let us help you plan to retire well.
Let's talk about 2 different ways to grow a portfolio. So the first one may be through what's called yield, or the interest and dividends that you may receive. So if you're holding different bonds, they're going to pay you interest. Savings or CD accounts used to, it seems like, pay a little better interest, but that's what you'd receive in those types of accounts. Meanwhile, if you're invested in maybe different types of stocks, will pay dividends. So they'll pay you, as an investor, they're going to pay you some type of recurring dividend for being invested in that stock. So let's use, for example, say a 4% yield within a stock. And with that, though, keep in mind that companies can increase or decrease that yield over time. So their dividends may fluctuate a bit. You may look at like rental properties as a potential income source, either leading up to retirement or in retirement. So you're hopeful that maybe there's a consistent income stream. That's something that I know for my parents. They use that as a plan 35 years ago to invest in rentals that would then provide an income stream to help pay for college tuition, which I'm grateful for. And so now my wife and I have gone down that similar path of investing in rental properties as part of a long-term investment plan. The second way to grow a portfolio is through capital appreciation. So this is where you're going to buy these stocks and wait it out with the hopes that they're going to grow over time and then eventually sell those stocks. So same would be true with maybe a rental property or other types of real estate, where you're going to buy it, hopefully buy it low, hold on to it, and sell it high is the ultimate goal there. There's, within the capital appreciation side of investments, as you're well aware of, there's a greater number of unknowns. So, you're hopeful that you're buying at a lower price with the expectation that that value is going to increase. But again, you don't know what that's going to look like over the long run. So, different investments are going to have these different objectives. So it's important to understand this. You might want to go into a portfolio if you're focused on more of the yield side, and you're looking at these dividend paying stocks. Again, you want to be aware of what risk that comes along with that, but you may be focused primarily on the income stream that it generates. So again, Centennial Wealth Advisory, we can dive behind these portfolios, better understand sort of what is the anticipated yield from a specific portfolio, so what sort of income can you count on, and then you try and look at, well, what's the risk factor within the appreciation side. So hope you found that helpful. Feel free to call Centennial Wealth Advisory if you'd like to sit down and get a second opinion on your portfolio.
Hey, welcome back. I hope you found that enjoyable, where you get to learn about the two different ways that you get to grow a portfolio. And what we've been saying this whole show was, hey, what is the purpose behind the position? You can get a lot of peace in understanding that once you've identified why you might take a dividend strategy approach, where we get to say, hey, look, our goal, our purpose is to take the interest and the dividends and reinvest them, and we can grow our portfolio that way. We have tools that can identify exactly what the yield is of the different positions. And so it's a helpful way to say, hey, the purpose of that strategy is to grow it using those dividends and interest and being reinvested. Or maybe you want to take those dividends and interest as income. Hey, we got a purpose behind that position. Maybe we want to go a little bit more speculative, or we want to try to grow our portfolio with that appreciation. If you can identify where in your portfolio you are trying to achieve that goal, I think a lot of peace comes from that. So the power of planning and understanding, digging into why you're doing what you're doing is so helpful.
Yeah, it's so important to just understand what's going on inside that portfolio. Very frequently, I'm getting asked, well, should I be invested in bonds at this point? People understand, hey, there's an inverse relationship with interest rates and bonds, right? The Fed have announced they're going to do 3, probably 4 different rate hikes this year alone. How does that affect bonds? Well, if interest rates go up, bond values go down, right? So that's where we want to make sure that we don't have too large of a portion of your portfolio allocated to bonds. But we also got to keep in mind that bonds are kind of where safety comes from in the market too. So these are all things that we got to look at. We got to make sure that we understand all the inner workings of what's going on inside that portfolio. So hopefully you found that very valuable. Please don't forget to check us out online, cen-wealth.com, and then also you can find all these episodes right on YouTube. Just type in Retiring Well in the search bar there, and I think the last 10 years of episodes have been uploaded. So a lot of awesome information out there if you want to check that out. We're going to have another episode coming up next week, so tune in next week.